David Lennox is a resource analyst at Fat Profits. He joins us now. David, welcome to First Look. Another point for Australia.
Sorry, I didn't catch that.
I said it's another good piece of economic data out of Australia.
Oh yes, look, I guess yesterday's GDP growth figures certainly pointed to the fact that Australia's miners have been generally pretty active over the last quarter, and for our country's point of view, for somewhat longer than that. So yes, it was good to see the resources again waving the flag for Australia.
But of course, the big question is China in the future. Is that government going to stimulate the economy and keep up demand for those resources, right?
Well, look, I guess we've probably seen the first steps of what the Chinese authorities are thinking about their own economy in terms of the rate cut that we saw last night. We do expect that over the course of time they will take a fairly cautious approach, because their economy, after all, is still growing at plus 8% or probably plus 7.5%. And I don't think they'll want to overly activate the economy, because we don't want to see it moving to a point where it's stretching a lot of friendships in terms of logistics chains, commodity chains. So look, we certainly think that the Chinese are doing the right thing at this particular point in time. They are watching the global economy slow. The US, as we know, is limping along. Euro is lame. So really they're the only engine that we've got left, and we would like to see them just very cautiously continue to stimulate their economy.
Let's talk about where oil prices fit into all of this. You say demand has actually fallen from the US. We know it's fallen from Europe. It's starting to wane, isn't it, from China as well? $83 a barrel. You said 80 is even a possibility here.
Look, I think some time ago we called on one of your sister programs that oil had the potential to drop towards $80 when you took away the risk factors that we'd seen in terms of the global supply shocks that had kept popping up in the oil markets over the last 12 months. Once you started to look at what was happening in the US, a very slow economy, the euro, a very slow or dead economy, China possibly slowing, you've got the three biggest users of petroleum product globally, and it was, I guess, a fairly easy point to draw that oil would collapse once the shock premiums came out of it, and that's what happened.
Well, you say the shock premiums are out of oil. I wonder if they should be. The International Atomic Energy Agency meeting next week about Iran. There's no real progress on that front.
Yes, look, I guess oil will never, unfortunately, lose that sort of ability to shock us. Unfortunately, the nature of the commodity, it's interwoven completely throughout our society, and unfortunately the nature of the region where the bulk of it's produced does tend to create these events.
Yeah.
You can't, unfortunately, as I said, take them away. So
David,
it could potentially surface.
Okay, what's OPEC going to do? I've got to ask you very quickly, because they meet next week as well on production quotas. What floor are they comfortable with for oil prices?
Well, I think Iran and Iraq have already suggested that they'd like to see the ceiling or the cap of 30 million barrels a day at least met, which does mean that OPEC would probably have to pull back about 1 million barrels of production. I'd like to be a fly on the wall for that meeting. We do think that, however, OPEC will probably look to perhaps counter the weakness that it's seen in its major customers in Europe and in the US and in Asia, and possibly considerably think about winding back production and perhaps just lowering the cap a little bit. But at this point in time, we've seen the usual argy-bargy at this point.
The usual argy-bargy. David Lennox, resource analyst at Fat Profits, thanks for being with us.